Hi, I'm Frank. Is this on? Okay, good. I'm Frank Hall with Entredime Consulting, and I'm going to talk about how to raise money for your startup without giving it away. It's a problem that happens a lot because in the early stages, no one knows how much your startup is worth, and yet you need money. So what portion of your equity do they get? I'm going to talk about a convertible note which has evolved as a leading mechanism for both investors and entrepreneurs to reach a fair relationship that lets early investment happen in a way that doesn't make you lose control or harm the investor by being diluted later. It's based basically on value. Your value proposition of your product or service leads to the valuation of your company. And you also have a value to society. That's part of what drives you. But the most important value involved is you, your passion for what you're doing. If that gets kicked in the gut because you've lost control and now you have brain-dead people making decisions about how your company, that fire goes out and all of that value evaporates. So you're going to need money for your dream, but you don't want to lose control. You need some seed money that maybe your founders put in or so forth, early stage that lets you prove your business model, and then a Series A or angel round, it's called, that lets you scale. Smart money is what you want. Smart investors value your passion, that fire in your gut. And anything but smart, patient money you don't want in your company for a variety of reasons. You want them to value you. So equity is what investors get when they put money in. It's a share of the ownership. Total equity is 100%. They don't make more than that. New investment dilutes your existing shareholders, so you better budget your equity before you promise any to anyone. Smart money is going to want about a third. That leaves controlling interest for your founders and some room for an incentive stock option program for your employees. These are just some general things. I use a spreadsheet when working with companies to plan this. So investment, let's take a look at a Series A, about 1.5 million on top of a pre-money valuation of 3 million. Will leave you, say, with 2/3 in a smaller round of 350K based on a 650 valuation. Still leaves you about the same, but what if they say your valuation is 150K? That's 30% for you. And oh no, if they don't even know what your valuation is, you're blocked in an argument that will lead you to no investment. So the solution is to break the Series A in two. The first phase, a convertible note, raises your investment that you need now, say 350K, but it doesn't convert to equity until the second phase, and it gathers interest that helps the investor while going. At the second phase is you raise the rest of what you need for the angel round, and professional investors then set the evaluation after you've been in business, growing, and now you're expensive and have a high valuation. The note with its interest converts at that valuation with some incentive, say a discount of 20%. So these are the parameters of a convertible note typically. Say what the max is you'll raise, $500,000, say use what you use it for, the interest rate, 8% is common. The angel round, additional raise that triggers the automatic conversion. Say an additional $1 million triggers it. Time to the angel round more than a year, you'll probably have to pay a higher interest rate. And the accrued converts at, say, a discount of 20%. So they get to buy $1 of equity for 80 cents. That gives them an incentive to be in early. But what if there's no angel round? You decide not to do that. Well, then there's a valuation of, say, 4.5 million, which is what the conversion can happen at. But it's optional. But it's not a secured note. If they want their money back, they have to make a deal with you. So how can you get a convertible note? Well, there's talk to me later. There's some good law firms. You want a good law firm to help you. How much does it cost? Because they have to do SEC filings and so forth, it may cost you between, say, $1,800 to $3,000. But it is well worth it because what you want is the power of a convertible note in your pocket. So why use it? Just summary, investors can tiptoe in. They can help you without having a huge amount of risk. You get what you need now and it converts at a higher valuation later. So I've given myself 2 slides worth of questions. If something was unclear, please raise your hand and speak loudly. So one question, office, is really what happens if there is no, if you have to make a deal? The investor will probably help you find better financing later. So use a convertible note if you're trying to raise money. I strongly recommend it.